That after today's jobs report and the recent rally in stocks and bonds. We'll ask our experts over the final stretch what's in store. In the meantime, your scorecard with 60 minutes to go and regulation looks like that. We do have green across the board, kind of been all over the map, but that's the current look. Yields are jumping today after the unemployment rate fell after the jobs report came out. There's your picture. We're green there, too. 224. The yield on the 10-year, but a pretty good day for mega cap tech, too. Apple is higher, holding above $3 trillion in market cap yet again. We'll speak to top analyst Eric Woodring of Morgan Stanley in just a few moments on what his expectations are for that stock in 2024. Alphabet, well, it's giving some back today as questions mount about the company's just rolled out AI model. All of it takes us to our talk of the tape. What lies ahead for stocks and next week's Fed meeting, which is looming large? Let's ask Cameron Dawson, Chief Investment Officer for NewEdge Wealth, here with me on sets. Good to see you out here.
Good to see you.
Anything changed for you by virtue of what was delivered today in the jobs report?
I think that nothing really changed. However, what we're not getting is confirmation that data is falling off a cliff, which just means that if we think about the 120 basis points of cuts that's being priced into markets, maybe that's a little bit ahead of itself. But when we think about the Fed going into next week, this data doesn't really change whether or not they'll hike. We don't think that they will hike, but it means that they probably won't endorse the Fed cut path that the bond market has priced in.
Well, I mean, March was probably a little aggressive, don't you think? I mean, that was 3 meetings from now.
Yeah.
But even if that is aggressive, the implication is that the Fed is going to cut in 2024, that the hikes are done, and the report today just underscores for many that a soft landing is in play.
Yeah, we're living in this super Goldilocks world where we're continuously threading this needle where we can have it all, where we can see the deceleration in wage growth. They were a little bit hotter today, but deceleration in wage growth and inflation data, and yet it's not coming with the pain. I think the question for markets next year is that we're starting to see little signs of weakness, a little bit of deterioration around the corners of the job market, not enough to say we're falling off a cliff, but does this little bit of easing turn into outright deterioration where we would be more concerned?
Are you growing more positive on the outlook for the market than you've been for the, let's say, the balance of 2023?
We think that there's still opportunity for earnings to surprise to the upside. That has been something that we haven't seen earnings revisions move much higher yet. You could still see better revenue growth and margins. That's been, you really want to dream the dream on margins. The thing I think that the challenge as we look at markets is that they are expensive. They're trading at 19 times forward. Markets re-rated aggressively this year. The S&P 500's PE is up 20%. So if there's upside in the market, it really is in those areas where PEs are lower, as well as in those areas where you see the potential for more earnings upside. Okay,
so I had Tom Lee of Fundstrat on with me yesterday on Closing Bell. Speaking of earnings, he says you can get, I know I was going to tell you to sit down, but you're already sitting down, 270, even 280, $280 on the most aggressive side of what he believes. His target for the S&P is 5,200. That's the highest on the street. And here's why he is so bullish. I want you to listen to what he said, and we can react on the other side. Tom Lee.
I think you have more groups that could actually have better earnings power into next year, and especially if caution comes off companies. CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
What do you think? Is he too optimistic?
I think that if we're looking into 2025, which is what that 270 number is, that's actually where consensus is as well. So what we can see is that that's not pricing in any kind of recession. We're not in the camp yet where we think we're going to have an imminent recession in the first half of 2024, but that's a long way away, end of 2025. So I think that's where we'll continuously have to look. Once you get to 19, 20 times that 25 number, that's when you're starting to be very aggressive on your estimates for the valuation at the same time that earnings would not be pricing in any potential downside.